Look at any screen on Wall Street today, and you will see a sea of red. The Dow Industrial Average dropped 500 points, and the Nasdaq erased nearly 600. That is a massive, violent sell-off in technology stocks happening right now. The speed of this reversal is catching everyone off guard. In the markets, there is an old saying that stocks take the escalator up and the elevator down. Right now, it looks like they are taking a bungee jump. The selling cascades, it preys on itself, and the entire narrative completely flips in a matter of hours. Compare this panic to the market we had just yesterday. We've been living through a period of extreme irrational exuberance. Momentum chasers and the FOMO crowd piled tightly into a handful of tech names, feeling they absolutely had to catch the wave. That crowded rally was built on one specific assumption. Investors believed that hyperscalers, the massive tech giants building cloud and AI infrastructure, would spend infinite capital, building larger data centers forever. This diagram maps out exactly what we're looking at today. This is a massive reality check. Limitless tech hype has violently collided with three very real limits: physical supply chains, geopolitical energy constraints, and regulatory gridlock. We have to start with the physical bottlenecks. The adoption of AI requires the largest infrastructure build-out in modern history, and that abstract digital growth relies entirely on extremely complex physical hardware. Wall Street was betting on trickle-down tech economics, hoping that massive spending from the top players would generate broad profits for everyone. Instead, the entire supply chain is hitting severe logjams. Multiple industries are fighting over the exact same semiconductor chips, the same parcels of land, and the same electrical power. You can see the immediate casualty of this bottleneck in companies like IBM. They are experiencing a massive sell-off today after a direct warning to investors. Their CEO stated plainly that they are losing wallet share. Take a look at this chart showing a typical corporate IT budget. There is not an infinite amount of money to go around. The skyrocketing cost of servers, memory, and data center space is eating up all the available cash, actively squeezing out consulting and standard software services. On top of these high costs, the market is currently flooding with new stock supply. From secondary offerings to highly anticipated IPOs, companies are issuing massive amounts of stock to raise cash. When you combine skyrocketing compute costs with a diluted pool of equity, the math stops working. A $1 trillion tech rally has simply outpaced the physical supply of hardware and the financial supply of investor cash. While the tech sector struggles to find enough electrical power for its data centers, a massive geopolitical shock is threatening the baseline energy supply for the entire global economy. Following a series of recent military strikes between the US and Iran, President Trump announced he is reinstating a severe blockade in the Middle East. The administration vowed a 20% fee on vessels crossing the Strait of Hormuz. That announcement sent immediate shockwaves, pushing oil past $80 a barrel. This geographic choke point acts as a direct tax, dictating the baseline inflation rate for every sector. When you get a sudden spike in base energy costs, it immediately chokes off the macroeconomic stability required to fund further expansion. Momentum-driven tech valuations cannot survive expensive oil. As the physical world of chips and power hits its current ceiling, focus is shifting toward the efficiency of digital ledger technology. Major financial players are attempting to bypass the rising costs and bottlenecks of traditional systems by tokenizing real-world assets, turning bonds and property into digital entries. But that transition is paralyzed by a severe lack of legal framework. The entire industry is currently staring down an August 7th make-or-break deadline for Congress to pass the Clarity Act. Major comprehensive crypto platforms like Coinbase are sitting on the sidelines. They have the technology to build out a full range of tokenized financial services, but they need regulatory certainty to legitimize the market and operate safely inside the United States. This diagram shows exactly how these legislative pieces fit together. Lawmakers are still debating ethics concerns regarding meme coin issuance. To fix this, the market rules established by the Clarity Act needs to be combined with the Genius Act, which specifically regulates stablecoins, the digital equivalent of the US dollar. Without these legal pillars firmly in place, you cannot build a functioning marketplace. Until Congress acts, the next era of digital economic growth remains grounded. The market is currently grinding through the immense friction of the most complex infrastructure build-out in modern history. Building this new economy requires an enormous amount of capital, cheap energy, and clear legal frameworks. Right now, all three of those requirements are under extreme stress. The narrative has shifted. The phase of blind, FOMO-driven investing is over. We have entered a phase where investors are demanding actual execution, physical delivery, and profitable earnings. This extreme volatility terrifies momentum traders. When the market reverses, it creates a chaotic environment that flushes out the speculative cash. Despite the current sell-off, massive capital commitments from the world's largest companies haven't disappeared, with leaders like Taiwan Semi still planning over $200 billion in U.S. expansion. For investors who can differentiate between a temporary price drop and a permanent failure, this purge of momentum chasers is resetting the entry price for an infrastructure cycle that is still in its earliest stages.